so much for joining. In this video, I talk about payout policy, give you an overview what companies can do to pay out excess cash flow, what the options are, what some of the considerations are, and how to think about payout policy. So in general, as discussed earlier, the company hopefully generates free cash flow, call it free cash flow to the firm, which includes equity holders and debt holders. Free cash flow debt holders. There's not much to discuss because these are mandatory. These are interest payments and principal repayments. So there's not much to discuss, depending on how much debt is outstanding, what the terms of the debt instruments are. You have to pay interest and you have to pay your principal. So there's not much to decide. However, when it comes to free cash flow, we call it FCFE, free cash flow to equity holders. Equity holders or shareholders, stockholders. There are some decisions to be made. And the first decision is, when we look at our shareholders, is do we actually pay out something to them? Or do we say, no, we are not giving you money back. Thanks for providing us capital in the first place. Thanks for investing in us. Thanks for buying shares. But we are not paying you out yet. We want to retain. We want to retain because, first, we want to invest in new projects. There are some expansion projects. We want to invest in a new factory because we see growth opportunities. Or we need to increase our cash position for unplanned opportunities. It's called financial slack. Yeah. So these are two ways of retaining money, and I'm not looking at those areas now. I do another video to see, and I talked about already in terms of when you should retain your money rather than paying it out. But then if you decide to give some money back, you have basically two main options. One is share repurchases or buybacks. It's the same, buybacks. Or you can pay them out as dividends. Yeah. So again, free cash flow to equity holders is optional. You don't need to pay out. You can retain, whether you declare dividends or whether you buy back shares or invest in new projects, increase your cash reserves. It's all up to you. Payout policy is basically the decision here of distributing free cash flow to equity holders. Yeah. And then the next question would be to think about, okay, do we buy back shares or do we pay out cash as dividends? In general, when looking at payout, we would think about, okay, we pay out money because we do not require cash for new projects. We don't have projects with a net present value over zero. Same, we don't have projects when the return on investment is greater than cost of capital. So if we don't have those opportunities, then it would be better to return our cash or free cash flow surplus to our investors. Yeah, there are different ways of doing this. From a dividend perspective, there are stock dividends, cash dividends, share repurchases can happen in the open market, selective buybacks, equal access. I will make another video on the mechanics. However, what I would like to do is give an idea of why do firms engage in share repurchases, and then what is the effect of share repurchases, and also what are dividends. Let's start with dividends because it's a bit easier. Dividends are payments of profits of the firm to its shareholders. They are not mandatory until a dividend is declared, and I will make another video of how the dividend payout process looks like. The board decides the amount and date of the dividend, and then once declared, the total amount is entered into the balance sheet as a current liability, and then basically gets sent out to the shareholders who are entitled to receive those dividends. Share purchases. It's a good way to change capital structure. Change capital structure. If the firm has too much equity, you buy back shares and you reduce your equity. So buying back shares increases financial leverage. Second, to reduce excess cash. Number 3, reduce excessive shares in the market. Excess shares, equity overhang, it's called equity overhang. A lot of shares that want to be sold but no major buyer. Large blocks of shares caused by major investor wanting to exit their position. So if there are big investors who actually want to sell their part. Also if there are excess employee stock options that have been vested, and so on. So when the firm repurchases shares, it actually removes them from the market. And number 4, it's signaling effect. Yeah, it has a signaling effect on the market. Usually, if a company buys back shares, what would happen to the share price? The number of outstanding shares reduces, which means the total value of equity is shared with fewer shareholders. However, at the same time, the total value of equity decreases because cash has been returned to shareholders. So you increase the number of shares outstanding, but also you decrease the number of shares outstanding, but you also decrease the value of equity. And because those two factors offset each other, the share price should, in theory, should remain constant. Yeah, so in share repurchases, the share price should remain constant. However, in practice, we see that share prices increase when companies announce share repurchases. And the main reason for that is when a firm buys back its own shares, it's signaling undervalued share price. So it says, okay, we're happy to buy our shares because we believe our shares are traded cheaply. which means we believe there's more potential. We believe if you look at the company, our shares should be valued more, but they are currently not. So when a company announces to buy back shares, it's signaling the share price under them. Because a company has more information than the shareholders, the shareholder think, oh, if the company decides to buy back shares, something positive must be going on. Otherwise, they wouldn't buy back their shares. And it has a positive effect. So the market sees this and reacts positively. Yeah, so this was an introduction. I will do another video on the dividend payout process and what we can do. We can also go into the detail of what would happen with the share price exactly and why is it that share price increases apart from the general signaling effect, because there are a few reasons why it is seen as a signaling effect. Good. I hope you found this video useful. Thank you so much for listening. Talk to you later. Bye bye.